All this data, what does it really mean? Hey, this is Dave with the Bolduc Realty Group, powered by eXp. Welcome to my weekly real estate market update. Today's Friday, August 11th. Hope you guys got a great weekend planned. Let's talk about the key Connecticut market stats. So active on the market today, we have 4,139 homes, down 24 from last week this time when we had 4,163. It's kind of flat. We had 316 new listings over the last 24 hours across the state. And in July, we sold 3,400 homes. That's down about 600 from June, but it's not some massive market-changing number. It's a few less houses. We're still at about 1.1, 1.2 months of inventory on the shelf, so it's still a strong seller's market. Some key dates here. CPI was in line with expectations, but July CPI was higher than June CPI, so a little stickiness in the inflation. The PPI report, on the other hand, that just came out this morning, it was above expectations. So we saw more inflation on the producer side than we were expecting. That positive CPI report in line with expectations led to a little bit of a stock rally yesterday. The market is set to reverse that because the PPI report today, the producer price index report today. And of note, there's the biggest increase month to month at 0.3% that we've seen since January in the PPI. So again, stickiness on inflation. We're not out of the woods yet. The next major report I'm tracking is the PCE, which is a personal consumption expenditure index report. This is a favorite of the Fed. It's due out August 31st. The Fed meets again in September. There's no August meeting. So it's going to be important to see how these next few reports come out. Until that next meeting, the market is going to react to the reports as they come out. Sticky inflation could lead to opening the door to the Fed raising interest rates again. Seems it's a little bit more likely after this PPI report. We'll have to see how that plays out. So I know I go through a lot of data. I just did. In these weekly updates. Hopefully it's useful. I'm a bit of a data geek. Sorry. I like digging in and figuring out what's going on, seeing the trends. I understand some people don't find that as fun, right? So what does all this data and what do these charts mean? Bottom line up front, I expect the buyer and seller experiences in the real estate market to pretty much remain the same. Buyers who want an HGTV experience are going to see limited options, multiple offers, over asking prices. They need to be persistent, be decisive, act quickly when you find the one because everybody else is out there looking for it too. If you're a little bit more flexible, you're willing to have some concessions on needs versus want, willing to do some renovation, you have some more options and you have maybe even a little bit of flexibility to negotiate. And you still need to be persistent. You still need to be in the market. The best way to succeed in this market is to be persistent and to be active in the market. It's a competitive market, and it's probably going to be like that in the short and midterm. Sellers who've maintained and updated their houses, you got a good likelihood of having that dream experience. Multiple above asking offers, maybe even some cash offers, maybe even appraisal gap coverage or waive inspections. Those could come in. Homes that need some work, it's going to be all about pricing. You could still get multiple offers, but you've got to price appropriately because price is the key. Overpriced homes, they're going to sit. Underpriced, buyers may still ask, hey, what's wrong with this house? Why is it underpriced? There's a pricing sweet spot for every house. We'll help you get into that sweet spot for your home. So there's some wild cards that I see based on the data, and this is all speculative, right? This is just, me looking at things and saying, hey, this is what I'm seeing. Buyer demand. Moody's issued a credit downgrade for 10 banks this week. And what they were concerned about was the commercial real estate market and those banks' exposure to it. And you would say, well, wait a minute. We're not talking about commercial real estate. We're talking about residential real estate. True. Banks have to look at their entire portfolio. If they're going to have a problem in one section of their portfolio or there's a risk there, they want to make sure that they can cover it in other sections and also that risk doesn't spread to those other sections. So one of the things some banks are doing is they're tightening their lending criteria. So what does that mean? That means the net result is it's going to be harder for buyers to get mortgages, which means that there'll be reduced demand for homes if this plays out. So something to watch. Inflation. Inflation is lower than it was a year ago, but it's still above the 2% Fed target. And also, June to July, the inflation numbers are showing that they're up a little bit. You still got that sticky inflation. So that opens the door to the Fed coming in September and saying, yeah, we need to raise interest rates again. They're certainly going to keep them high. They may raise them again. So at some point, those high interest rates could and probably will cause the economy to stall, which would bring in about a recession. Time's going to tell on that one. And now recessions, right? A recession's dramatically reduced demand because people are pulling back to conserve capital, to conserve income, or maybe because they horribly lost their job and they don't have income anymore. A recession may also force the hand of homeowners to sell. Maybe they lost a job, whatever the reason is. If too many homes go on the market at the same time that recession is driving demand down, you could actually see the whole market flip, and you could end up with buyers in control and sellers worrying about limited options. So the wild cards I just mentioned, they come from interpreting data trends, looking at what's going on out there. There's nothing guaranteed here. I do watch that acronym that I talked about, FILE, which is foreclosures, inventory, lending practices, and employment. And I watch them for just that reason. If things are starting to happen and they're all going in the same direction in all those areas, then it's a time for us to really watch what's happening. So primary mortgage market survey, mortgage rates are up again this week. The weak jobs report, it really didn't have too much of an effect on mortgage rates. So on average, mortgage rates have been about 1.7 percentage points higher than the 10-year Treasury yield. And all yield means is it's the interest rate paid over a year. So a 4% interest or 4% yield is 4% interest rate paid over a year. So the 10-year yield is about 4%. So on average, mortgage rates should be 4% plus 1.7 or 5.7%. They're actually about 7%. That difference between the actual mortgage rate and what the historic average says it should be is a representative of the risk that the market sees in housing and sees in the mortgage sector. So you can tell the market sees a lot of risks in those sectors. Rates are forecast to come down this year and into next year. If we actually see inflation cool off and we see the risk of recession go away, then yeah, we will see that risk priced out of the mortgage rates and we will see mortgage rates come down. It's going to take some time. We're going to have to watch it, and hopefully we continue to see inflation reports in a favorable light and jobs and things like that. Hopefully that was helpful. If you have questions, comments, feedback, if you want me to talk about anything else, please throw it in the comments below. Have a great weekend.